Good afternoon, everyone. I'm Sophie Richard, counsel in the knowledge management team of Arendt. Welcome to the third webinar of our tax week. Today we will talk about the impact of recent tax developments on the asset management industry in Luxembourg. And for these discussions, we have a panel of three speakers. First, we have Jan Neugebauer, who is partner in the tax law practice of Arendt. Jan has more than 15 years of experience. He specializes in tax structuring for investment funds, corporate entities, and he focuses on the structuring of capital market transactions. And then we have Yves-Philippe Pardefoy, who is counsel in the tax law practice of Arendt. He has more than 10 years of experience, and he advises national and international on issues with focus on fund structuring, financial transactions, and transactions relating to Spanish and Latin American investment and investors. And finally, we have Ivan Stempnerski of Counsels, member also of the tax law practice of Arendt, where he's in charge of the financial reporting and accounting standard practice. He advises clients on the accounting treatment of complex transactions under Luxembourg GAAP, Belgian GAAP, and IFRS. And he's also a lecturer in financial reporting law at the University of Louvain in Belgium. Before we get started, as usual, a few words on the usual housekeeping rules. First, there is a Q&A section in the WebEx where you can ask all your questions during the webinar, and our speakers will address your questions after the presentation. In addition, if you have any technical issues, please use the chat box. Now, Yves, Ivan, Jan, I'm very happy that you will share with us your views on several tax developments that will impact our clients as from 2023.
Thank you, Sophie. So I will start now by explaining the clarification of the reverse hybrid rule that we had at the end of last year. I think we can go to the next slide. Yeah. So hopefully this rule, most of you are already familiar with it because it has been applying since tax year 2022. For those of you who are not familiar with it, let's go a bit through how it works. So in a nutshell, this rule is trying to solve a situation where you have a Luxembourg transparent entity that has its income, and the income is not taxable in Luxembourg because of the transparency, but it's also not taxable at investor level for different reasons. And the rule, when it applies, would make the partnership become taxable in Luxembourg. Obviously, you need to meet certain conditions for this rule to apply, and we will go through them. You can see that as conditions that are cumulative or as steps that you need to follow to make sure or to assess if the rule applies or not. The first one is you need to have investors that are associated enterprises. So for that one, you would take an investor, either alone or you combine or you aggregate with other investors that are acting together. You will need to see if that investor or investors hold 50% or more of the partnership, and for that test we have a look at the voting rights, the capital, or the profit entitlement. So that's the first test. If you do not meet the test, you stop there. If you meet the test, then you need to see among those investors that qualify associated enterprise, you need to understand how they view the Luxembourg partnership. Are they viewing that as transparent, or are they viewing that as an opaque entity? And the reason that they can view things that way is because, as you probably know, different countries have different rules regarding how to classify foreign entities. You can have different countries seeing something that is transparent in Luxembourg as opaque in their jurisdiction, for example. So you have a look at all of these investors that qualify associated enterprise, and you see if they see the partnership as opaque or not. Then, for those that see the partnership as opaque, you aggregate their stakes, let's say, and you see if among all of them they hold a majority of the interest in the partnership. If that is the case, then the risk there is that the partnership may become taxable in Luxembourg. And that's exactly where the clarification comes into play, and that is helpful. You can see that as either an additional condition or another thing that you need to ask yourself when you're assessing the rule. The clarification adds something that is very important is to understand why is the investor not taking into account the net income of the partnership. Is it because the investor sees the partnership as opaque, or is it because of another reason? And the idea is that the rule should only apply only if the net income of the partnership is not taken into account because of a difference in classification, a difference in the way that you see the partnership in Luxembourg and in the investor jurisdiction. And there, the parliamentary works specifically address the situation of tax-exempt investors, so investors that are subject or that have a subjective exemption, personal exemption. But you could also ask yourself the question regarding other types of investors, for example, investors that are resident in no tax jurisdictions, or investors that are resident in jurisdictions that apply a territorial tax regime, so those where only income generated in that country would be taxable. And the idea is that if in any case the income of the partnership would not have been taken into account at investor level because the investor was tax exempt or not subject to tax in its country, or let's say for any other reason that the difference in classification, then the rule should not apply. So that will certainly simplify your analysis regarding ETA 2. Just to make sure also that something should be very clear, there are no changes regarding the exemption that is very often used by asset managers, so the collective investment vehicle exemption, where you have different conditions to apply and on which many asset managers are relying. So that doesn't change. So this is just a clarification that will help you in your assessment or simplify your assessment, let's say.
Thank you, Yves, and a warm welcome also from my side. We will be using the next 20 minutes, more or less, through two brief cases to introduce you to a new subject, which at first glance, and more generally also from a policy perspective, probably doesn't intend to target investment funds. But as always, and we have seen that, for example, under CBCR, those rules, even though not intended to address investment fund structures, unfortunately have the effect to address them and affect them in any case in that context. So directors and in-house teams of GPs and LPs need to be aware of those rules going into place as of the 1st of December 2023 in Luxembourg. Think about whether they may have an impact on the IRR of your fund. I'm sure it would probably have an impact on the tax compliance burden going forward, and perhaps need to restructure or think about whether address certain consolidation accounting questions differently going forward as well. So what are the rules we're actually talking about? We are talking about so-called globe rules or Pillar 2 rules, for which the OECD has worked on for the last couple of years, and it is targeted primarily on industries and multinationals which are active in the digital sector. At least initially that was the case, but has been extended more or less to all multinational groups, which have an overall annual turnover of 750 million euros per year. And what is it trying to achieve actually is that directive going forward? It's trying to achieve that on a global level, there's a minimum taxable base of 15%, which large groups will have to pay going forward on a global level. And based on that directive, basically the EU member state have to implement those rules going forward within the EU legislation. So very in a nutshell basis and on a very high level basis in that regard, how is that rule going to work? First of all, there will be an introduction of a so-called top-up tax, which will ensure that on a country-by-country basis or jurisdiction-by-jurisdiction basis, there is an effective tax rate of actually 15% in each jurisdiction where the multinational group is actually relevant and acting in that regard. And what happens in that context, if that is not the case, we don't have the effective tax rate of 15%, which means we have low taxed income in certain jurisdictions. We will have an income inclusion rule going forward, where at the level of a parent company or a parent entity of a multinational group or a large-scale domestic group, which is more or less the exception in that regard, there is basically a computation of a minimum inclusion of that relevant income, and that relevant top-up tax is being paid in that context. So, however, then in that context, if for some reason the income inclusion rule doesn't apply to an entity, There is a backdrop in the legislation, which is called the under-tax profit rule in that regard, where basically on a pro rata basis, constituent entities of an M&E group in that context can basically be obliged to pay that under-tax profit, under that under-tax profit rule, additional cash taxes in the relevant jurisdiction to the extent there is no income inclusion at the level of the parent entity. We, today, we're not going to talk about really of the technicalities of those rules going forward, but we'll try to explain to you why is that directive actually relevant for the investment funds. Because now we have talked a lot about multinational groups, and usually we'll see whether we fall within those considerations. So what is actually the scope of that EU minimum taxation directive in that regard? So the scope of it is, first of all, we need entities which are located in a jurisdiction, which are part of an M&E group, or a large-scale domestic group with an annual consolidated revenue of more than 750 million, which has been realized in at least 2 of the last 4 fiscal years. Again, we're making references to group in that context, and we'll talk about the group definition a bit at a later stage. Fortunately for the fund industries, these directives, however, foresee certain exceptions and excluded entities to which those rules per se should not apply. And as you can see, we have pension funds, we have investment funds, which are excluded entities to the extent they are ultimate parent entities in that regard. What is an investment fund in that context? Just very briefly, if you have a traditional investment fund, very likely a lot of those conditions will be met, but it refers to an entity which basically pools financial or non-financial assets, has a fixed investment policy. There is a risk spreading requirement in that regard, that the entity itself or its management are actually regulated. So a lot of those conditions will quite often be fulfilled for a Luxembourg-based investment fund. So already, hopefully, good news that quite often funds itself should per se be excluded entities going forward. But still we'll see whether that will actually be the case for all cases in that regard. So there are other entities which are exempt as well. We have government entities, international organizations, and very luckily as well, there are certain entities, to the extent they are owned by excluded entities and primarily hold assets or invest funds on behalf of those investment entities or excluded entities, which are their shareholders, and they are held at least for 95% by those excluded entities. They are excluded from the scope of Pillar 2 as well. There's also a different notion of it. It's an 85% threshold, so to the extent those holding companies are held at 85% by excluded entities, they will be exempt as well, or excluded entities as well, to the extent they primarily derive dividends and capital gains from substantial shareholdings in that regard. So that can be an alternative as well for the exclusion of those entities from Pillar 2. But, of course, if we have sort of shareholder financing or something else in the structure where it's not dividend or capital gains being derived from the structure, then likely that rule will not apply. So, very broadly, that is the scope of the structure. We'll try to go into a bit a case study for the structure with a very simplified fund structure and transactional structure we see very typically in Luxembourg in that regard. So we try to actually determine what is actually the scope of Pillar 2 for that fund structure, and do we, through the excluded entities definition, really are we sure that we are excluding all of the funds in that context from the application of the Pillar 2. So if we start with the STSP here at the top, you see that we have an STSP with various investors, and we assume those various investors don't consolidate basically the partnership. So we have the partnership on the top, which is a GP in that context, and it is basically an entity for the purpose of Pillar 2. So it's an entity which is generally within the scope, given it has, even though it has no legal personality, it has to prepare accounts based on the commercial code of the Luxembourg law in that context. So it is generally within an entity within the scope of the directive. So the question is a bit, in that context, is it a UP? And what is actually an ultimate parent entity in that context? An ultimate parent entity is basically an entity which owns directly or indirectly a controlling interest in any other entity and that is not owned directly or indirectly by another entity with a controlling interest. Unfortunately, however, we have the two rules. So on the one hand, we have the OECD rules, which came in 2021 in that regard, or were proposed in 2021, and we have the directive, basically, which came into force, or which was finalized end of last year, and we have a slightly different notion of controlling interest. Under the OECD definition, controlling interest means basically that an ownership interest in entities, that the interest holder is required to consolidate the asset, liabilities, income, expenses, cash flows of the entity on a line-by-line basis in accordance with an acceptable financial standard, and or would have been required to consolidate the asset, liabilities, or income on a line-by-line basis if the interest holder had prepared consolidated financial statements. In the EU definition, that last part of the definition of the OECD is actually missing in that regard. So the question in that regard, a bit to Yvonne in that context, doesn't SCSP actually have to consolidate in that context?
Yes, thank you. Yeah, it's indeed a very relevant question. As you know, Luxembourg SCSPs are not required by Luxembourg GAAP to prepare consolidated financial statements. SCSP have nevertheless the possibility on a voluntary basis to do so, to prepare consolidated financial statements, and in such a case could opt notably for Luxembourg GAAP, for Luxembourg GAAP plus fair value option, for IFRS or any other set of accounting standards. In addition, would the SCSP, in your example, opt for IFRS in Luxembourg as endorsed in the EU or any other form of IFRS, it might then qualify as an investment entity. According to IFRS as defined by IFRS 10, and you can see the definition on the slide. I will come back a little bit later on this definition. But by application of this standard, IFRS 10, the SCSP would be prohibited from preparing consolidated financial statements on a line-by-line basis. When you look at this definition, you understand that the application of this definition is not so easy, and that's why application guidance is provided by IFRS 10 in order to help to assess whether a parent company meets or not this definition. As already mentioned, the consequence of such a qualification as investment entity under IFRS 10 is the prohibition from consolidating its subsidiaries. Instead, the investment entity shall measure the investment in its subsidiaries at fair value through profit and loss, because according to the IASB, such a measurement is more relevant than the consolidation.
Thank you, Yvonne. So if we look at that definition again of the UPE and the controlling interest in that regard, so if we have the two conditions, either it is required to consolidate in that context, so that one we don't have, as you just explained in that context, and then there is a deemed requirement, or deemed consolidation requirement in that regard. And there is probably a bit of debate going on, and actually how to interpret that notion. Is that just an abuse provision, basically, which allows you, basically, or allows member states to sort of have an assumed ultimate parent entity to the extent there is, at the level of the ultimate parent entity, actually no acceptable consolidated financial statement applied in the relevant jurisdiction, and then you put the entity into the situation where actually it would have provided consolidated statements. On the other hand, the other question in that regard is very clear in that regard. An SCSP, AIF, doesn't usually prepare consolidated financial statements in Luxembourg. Okay. So really the question in that regard will be, to the extent we don't have consolidated financial statement at the level of the SCSP, AIF, is there some argument either on the basis of the prior notion that it is a pure abuse rule in that regard, that deemed consolidation requirement, or is there another argument to say, actually based, for example, on the investment entity classification you just made, there is actually no obligation of the relevant SCSP. We have it for two reasons. First of all, it doesn't in general have to prepare consolidated accounts. And then on the other reason, because even if we would have consolidated account, perhaps we can apply the investment entity exemption, and then we don't have a line-by-line consolidation in that regard. So I think something very to closely look at in the future as well. And perhaps so we're quite comfortable, hopefully, that one, the STSP, will not be an OPE. So we'll go one step further down. What we see quite often in a typical structure is basically that you have a structure where you have a RAIF C-car potentially as an aggregator for our various fund vehicles, which go into that vehicles, can be a RAIF C-car, can be a RAIF SIF, SA in that context. Here we have another investor coming in, and that other investor holds less than 5%, for example, or those investors hold less than 5% and would be, in that context, again, be an excluded entity as the STSP AIF, if we even would fall within the scope of that rule. So if the STSP AIF is not an OPE, is the RAIF C-car an UPE? Do we have a consolidation requirement at that level in that context?
Also, it's a very good question. Under Lux Gap, the control, contrary to IFRS, is defined in terms of having the majority of the voting rights or the right to appoint or to remove the majority of board members. And the consolidation requirement is triggered by the exclusive control of at least one subsidiary. So in the case at hand, provided the RAIF SIF SA, because it is an SA, has at least one subsidiary, as a rule, this SA should prepare consolidated financial statements. However, no consolidated financial statements are required from parent company having the legal status of a RAIF or SIF. So in the case at hand, clearly, because these entities are indeed legally exempted from the requirements of drafting of consolidated financial statements due to their sectorial law, no consolidated financial statements would be prepared again.
And again, so thanks, Yvonne. So it's a bit similar question in that context here to the extent. So we don't have actually, again,
exactly
consolidated accounts at the level of the RAIF C-car or a SIF, doesn't matter, or any other regulated entity in Luxembourg in the fund context. They all have an exemption to provide consolidated accounts.
Yes, in the first case of the SCSP, there is no legal requirement. In the second case of the C-car, there is a legal exemption.
Yeah, correct. And then the question, again, very similar to the first case, the question will be to the extent, do we have to apply the deemed consolidation question in that regard? And there the question, again, is to the extent, can we just say we don't have an obligation to prepare any financial accounts or to prepare consolidated financial accounts? Or do we have to say going forward as well that even if we would be required to prepare financial accounts, we wouldn't be required to prepare them on a line-by-line basis, for example, because we can prepare investment entity or apply the investment entity rule in that regard under IFRS. So things to be monitored, things to be checked, because there's not a lot of guidance on that one here, but there is sort of under the various working groups in industrial associations, there is sort of thoughts about whether some guidance can be provided in that regard, and we'll see where we'll end up at the very end, and hopefully some guidance will be provided by the tax authorities in that regard as well. Going one step down, usually we don't stop with that entity, especially in the private equity or real estate sector, and we have a holding company in Luxembourg which doesn't have anymore any regulatory regime attached to it. So it's a pure holding company and financing company in that regard. What's there the case on the holdco?
Yes, as already mentioned, for an SA, clearly an SA like holdco controlling, within, of course, the meaning of Lux Gap, alone, at least one subsidiary has, as a rule, to prepare consolidated financial statements. However, exemptions are possible under Lux Gap, such as the well-known private equity exemption, where the shares of all subsidiaries are held exclusively with a view to their subsequent resale and provided certain conditions are met. Moreover, and also as already mentioned, would Holdco SA, in the case at hand, opt for IFRS, again it might then qualify as an investment entity according to IFRS 10 and be then prohibited from preparing consolidated financial statements.
Thank you, Iman. So we go further one level down in the structure. So quite often in those structures, actually the holdco will usually in practice either apply the private equity exemption or the investment entity exemption in Luxembourg to provide the accounts. But it would still be an excluded entity even if it would qualify as an entity for purpose of the Pillar 2 rules, given it's held by 95% by an excluded entity in that regard. So that one is fine. Then now we go actually to an entity which sits then below the fund. So that's actually the deal structure going forward. You have a third-party investor which comes into play, 30% holding of the relevant JV co as a co-invest structure. In that context, for example, then the question will be indeed more relevant because quite often then it's no longer an excluded entity if the third party is not in itself an excluded entity in that regard. So we are clearly within the scope of those rules if the turnover of the underlying group is at 750 million in that context per year. So the question then will be, and we assume that the JV co actually has to consolidate in that context the underlying entities, then at least at that level, if we wouldn't have a UPE on top of the company, so neither holdco, neither the RAIF, neither the fund are UPEs and are not part of the group in that context, then the JV co would just have to look down actually to determine the turnover and whether to what extent Pillar 2 rules apply with regard to the underlying propcos and entities in that regard. However, if for some reason we cannot apply any of those exceptions and any of those rules with regard to those entities, and we would only have that notion of excluded entities in that context under Pillar 2, so we cannot exclude those intermediate holdings from the group concept or the UPE concept in that regard, which both of them has the conditions of that or that possibility, or either of a obligation to prepare consolidated accounts under the group concept as well, or that deemed consolidation requirement in that context. If we, for some reason, would have the rule that those entities are actually within the scope of Pillar 2, but excluded entities, we would still have to look at those entities in order to actually determine whether 750 million threshold is included in that context. And then the consequence will be that probably you need to look at the holdco SA level or at the RAIF ZCAR level with the other subsidiaries, if there are other subsidiaries, and potentially include all of those turnovers within the calculation of actually your group. And then, of course, the 750 million threshold will be much easier be obtained in that context rather than if you just need to look down in the structure below the JV co in order to determine the threshold. So that's a bit the risk there is if the correct accounting treatment or accounting consolidation treatment is not applied, and we'll need to see a bit going forward how that will be implemented. And I think Yves and Yvonne will briefly talk about the second case.
Yes, hopefully this one is a bit easier to go through. And we will use the concepts that we just went through with Jan and Yvonne. So in this case, we have an existing multinational group. Here it's an insurance group that holds a Luxembourg investment fund. And here it's a UCI Part 2 in the form of a Société Anonyme. So, and the idea here is we will go through the same checks that we went through in the last example. The first question that we need to ask ourselves is the fund, so the SA, a constituted entity, so part of that group or not? And as we explained, that one is checked by asking ourselves, is the entity related by ways of control or ownership based on generally accepted financial standards, like accounting standards, for the preparation of consolidated annual accounts at the level then of the ultimate parent entity. And that maybe, Yvan, you can explain how we would...
Yes, and we assume that the non-EU investor prepares already consolidated financial statements by using IFRS.
Yes.
Okay. It's important to mention immediately that the consolidation of the Luxembourg fund, having thus the legal form of an SA, by this non-EU investor applying IFRS, will of course require the control of the fund by the investor. But what is very important is to underline that contrary to LuxGap, the control under IFRS is defined in terms of power over the fund, and power means existing rights, giving the current ability to direct the relevant activities of the fund, exposure or rights to variable return from its involvement with the fund, and last but not least, the ability to use its power over the fund to affect the amount of the return. So all these conditions must be met in order to be able to say, yes, we control the Luxembourg fund. Of course, you can assume that the existence of the control under IFRS may sometimes require an in-depth analysis, of course.
Thank you, Yvan. So then let's assume that the fund is a constituent entity of the M&A group. The second question that we need to ask ourselves is, can we benefit from the excluded entity concept? And for that one, you may say, here we have an investment fund, it should be an excluded entity, right? But here, what you should not forget is that the excluded entity concept only works if you are an investment fund, but if you are also the ultimate parent entity. And in this case, the fund is not the ultimate parent entity, and is also not held by other excluded entities. So you cannot benefit from that concept. So you need to move forward. Then you end up in a situation where you are in the scope of the rules, and the next question that you need to ask yourselves is, how do the allocation rules work? So how are we going to determine the effective tax rate here and the top-up tax? In this specific case, what you should know is that investment entities have a specific way of calculating the effective tax rate, and is a way that is different or separate from the way that you would calculate the effective tax rate applying in the country where they are located. So here, Luxembourg. And it's a way of calculating that is more or less a standalone calculation. If we take this investment fund, we know that this type of funds are only subject to the subscription tax. So that's the starting point. Then we would compare that with the minimum objective that we have, that is the 15% minimum tax rate. We know that the investment fund here would be below the effective tax rate of 15%. And then the conclusion should be, there is a top-up tax that would apply, and that top-up tax would need to be paid by the ultimate parent entity. And that would be the case here because the ultimate parent entity is in another country that also applies rules that are similar to the Pillar 2 Directive rules. It would be the same if we had another ultimate parent entity that is part of the EU, for example. So if you stop there, you have a top-up tax that would be due and would be payable by the ultimate parent entity. If you have a parent entity that is somewhere not applying Pillar 2 rules, then that obligation to pay the top-up tax would shift to the EU costs that you see on the chart, so the ones that are in the scope of the directive. So this is the standard rule. But for investment funds, we have two other possibilities to make a bit our lives easier. The first one is what we called the tax transparent entity. So it's to consider the investment fund as a tax transparent entity. And you have some conditions to be able to do that. First, you need an investor that computes its taxes using a fair market value mechanism. So for example, mark to market. So in that one, if the investor is taking that to use or to assess its taxation with respect to the fund, you would have a situation where you have the fund generating income. That income is going to increase its fair market value, and then the investor is going to pick up that increase and be taxable on that. So that's the first condition. The second condition is you need to have an investor that is sufficiently taxed, and that you come back again to the 15% tax or more. So if you meet these two conditions, you can avoid the application of the calculation of the top-up tax that would need to be paid by the ultimate parent entity. The other possibility or other election is the taxable distribution method. And that one is simply to say that if the fund is distributing its income, the qualifying income for the purpose of these rules, and that income is being picked up and being taxable at the level of the investor, and that investor is sufficiently taxed, again, the concept of 15% or more, then that's fine, and it's another way to avoid the standard rules and the calculation of the top-up tax.
Thank you, Yves. Yes, and those rules in practice, when we have those discussions, always turn around questions. Do we have to consolidate, actually? And then, because those rules actually under Pillar 2, to the extent they are applicable, are not always so easy to be fulfilled, actually. There's actually quite often a lot of countries don't allow mark-to-market evaluation for tax purposes. So it's not quite as easy for those funds and those multinational groups actually to apply those rules going forward. Yeah. And just very briefly, and I will keep it short in 30 seconds, some very minor points on still in that context. So the EU blacklist has been amended, as you all know probably, but it's updated twice a year. So nowadays, Bahamas has been included as the most recent one. 3 consequences in Luxembourg on that one. First of all, DAX 6. You need to be aware that there's potentially DAX 6 reporting. There is a disclosure requirements for transfer pricing purposes in that regard. And lastly, there is a deductibility denial in certain cases if there are payments made to those entities. Those of you who have funds which are subject to subscription tax and try to apply the reduced subscription tax for ESG purposes, be aware that from the scope of that reduced subscription tax, natural gas and nuclear power have been excluded, given the general position of the Luxembourg government in relation to those 2 aspects of that regard. Unshell, you all are waiting for probably how that will go on. Last news, of course, was that the EU Parliament had agreed on a wording in that regard last week in that regard. However, the Czech Parliament or the Czech presidency end of last year said that it would still be quite some technical work required in order for it to go forward. The Swedish EU Council presidency seems to be not to have it on the top priority for those 6 months which are at the moment ongoing. So we'll wait probably until the next presidency, which is, I think, the Spanish in that regard, whether there will be any work going forward. DEPRA is at the moment off the table, and BFIT, I think it's something which may come, but given the outcome of CCCTB in the past, so the corporate consolidated common tax base on the EU basis, doubtful whether that will come as well in the future. So Sophie, I think you can wrap it up now.
Thank you, Jan. Thank you to all. Yeah, actually we are running a bit late, so I think we will conclude now. We have a few questions, but we will address them separately. So thank you to all thank you to the speakers and for you for joining today. We still have some session tomorrow and the day after. So tomorrow we have a session which will focus on real estate fund structuring and market trend update. And on Friday, we have a VAT specific session. So thank you and have a good day.
Thank you.
Thank you.